All right, so today we're going to get into, can you actually time the stock market, right? Is there truly a science behind it? Can you trade through, and are you going to be able to do better than the people that have the computers warehoused right next to the mainframe so that the T1 line comes in and they can get in a split second before you? So before we get too deep into it, let's talk about what it means to actually time the stock market. Right here, according to Investopedia, market timing is the act of moving investment money in or out of a financial market, or switching between asset classes based on predictive methods. If investors can predict when the market will go up and down, they can make trades to turn that market move into a profit. Let's think about this. Are you able to predict the future? Is anybody really able to predict the future, right? There's a lot of what's called algorithmic trading, where computers are actually trying to predict and model what's going to happen, and institutional investors rely upon this. The question is, can you look at those same trends and figure out what's going to happen so that you can make moves in and out of the market at the right time to reap those profits and rewards? So as we're looking at market timing, right, is there an alternative to that? And the answer is yes. And what we're going to get into is this idea of buy and hold, right, which is completely different than the people that are trying to time the market. Market timing is the opposite of a buy and hold strategy, where investors buy securities and hold them for long periods of time, regardless of what the market is doing. While some people panic and sell when stocks plummet, holding with diamond hands is a longer-term alternative to timing the market. Some of the richest people who acquired the most amount of wealth, people like Warren Buffett, believe in this type of strategy. Warren Buffett buys something and he doesn't care what the price is necessarily, because he believes so much in the company and he does the due diligence behind each and every stock that he purchases. So he continues to buy in no matter what that company is doing. And in fact, when stocks pull back, he's probably going to go in for more so that he can acquire and get this company that he loves at a deeper discount. The other thing you have to think about when you're looking at market timing is this concept called time diversification. According to Forbes, time diversification refers to the notion that time diversifies risk, implying that the volatility of risky assets falls over a long period of time. Since the start of the S&P 500, there has never been any 14-plus year period when stock market has lost money. So what's that telling you? That's telling you that over a long period of time, the stock market trends generally in an upward position. But what do you notice during these times is there's volatility that happens all throughout the market. So let's talk about what this time diversification means. A lot of times when you're looking at all the different charts that are out there, and if you go back and look at a chart of the S&P 500, starting in the year 1980 and going out to today, what you're going to find is a little bit like this, right? And it starts to, over time, move up and down, right? So this is a zoomed out version of this time period where it looks like it's basically going up the whole time. But what are you, the investor, what are you feeling every time the market moves? And the news cycle talks about it, right? You're no longer looking at this zoomed out time diversified model. You're looking at what's happening today. And this is what it feels like in the stock market, right? There's peaks and valleys at all times. So the question is, can you time when these low points are going to hit and buy into the market? Or is it better to simply continuously buy into the market and do what's called dollar cost averaging? That way, sometimes you're buying at a higher price, sometimes you're buying at a lower price, but over time, the cost of your stock that you own averages out. So as you're thinking about timing the market, one thing you want to consider is, what does it look like as far as moving in and out, and what is the effect of that on your portfolio? So let's look at what Forbes says, right? The 10 best days in the market. Look at the last 20 years. If in the last 20 years, the value of the S&P has grown 284%, That's in the last 20 years. But if you had missed the best 10 days out of the more than 5,000 days that you would have been in that market, you would only receive a 76% growth on those dollars. So look at the difference that happens from being in the market, right, and being out of the market. And so it really becomes a question of, do you want to time the market or do you want time in the market? What we talked about briefly before was this idea of dollar cost averaging. So let's get a little more in-depth into what that really means. According to Forbes, dollar cost averaging is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price. Dollar cost averaging has been proven to be the most consistent and profitable way to invest in the stock market. You'll never need to worry about short-term volatility, right? So as we just showed before, markets get volatile. People try to move out of the markets. They try to move into markets when things are going really well. What's happening there? You're making a decision based on either fear, because the market's falling and you don't want to lose money, or greed, the market's running up and you don't want to miss out, right? That fear of missing out drives the markets. So you want to think about putting together a plan, having a consistent philosophy, buying stuff that you believe in, not just in the good times, but even in the bad times, and then putting that money in consistently over time. That's what dollar cost averaging is. Warren Buffett says that the best time to plant a tree was 20 years ago, but the second best time to plant a tree is today. And investing is the same way. Had you started 20 years ago, you're probably looking pretty good right now as long as you stayed consistent in the market, right? We saw that 284% growth. But if you're getting started or you're in a position where you're fearful of everything that's going on and you want to have a deeper conversation around your economic philosophy and really starting to understand your tolerance for risk and where you should be putting your money and all the different products that are out there, click the link below. One of the Epic strategists will reach out, walk you through, and help you build out a customized game plan. Thank you so much for staying with us through this video. Hopefully now you have a little better understanding of what it actually means to time the market and all the different things that are involved in that you really have to understand. If you like this video, go ahead and hit the like button. Hit that subscribe button and ring the bell. That way you'll get notifications every single day as we put out new content just like this. And if you're enjoying this, stick around. Here's another video for you.